Please welcome our guests to the stage.
All right, thank you for being here. We have a big and wide panel today to talk about banks and banking, which is an interesting topic, believe it or not. Maybe I'm going to start with the elephant in the room and with you, Marc. Nearly 6 months ago, a bit more than 6 months ago, there was the huge SVB crisis that made the headlines everywhere, the front page of all the newspapers. You work for SVB now. What is SVB today?
Yeah, so first, thanks for having me on. It's great to be on this somewhat ironically named panel, since SVB is still very much here, though I understand the sense in which you mean it. And a lot did change, certainly in March, and I think so much has been talked about, I think, with regard to those fateful 2 days, that Thursday, Friday. What I think is maybe the more interesting story is the one people haven't heard yet, which is what happened next in the days that followed, which was really, here I'll say for all the startup entrepreneurs and the investors that back them, it was a great study in why culture matters. The events of that Thursday, Friday were very traumatic. Our employees didn't know what was going to happen next. There was so much.
Bring us back to this moment. How did you learn that things are going sideways at SVB on this Friday? Did you receive a phone call?
So by Friday, things had already gone very much sideways. And so Friday was the arrival of the FDIC. And that really began what I think of as the story about why culture matters, because ultimately reflexes took over. I think there was so much emotional investment in the mission of our company, serving the innovation economy, that despite this incredible traumatic event, despite people not knowing what was going to happen next, people really rallied. And our first mission was open next Monday as a bridge bank. And what went on that weekend to get to that place, and then what went on for the 2 weeks of operating as a bridge bank while trying to find an acquirer, and then what happened post-acquisition to reopen again as a division of First Citizens, again, was just an extraordinary story that hasn't gotten much airtime. And so I'll end by saying I'm eternally grateful to all of our employees who rallied and get us to this point where we are today, which is back doing all the things we were doing before, probably with an extra dose of empathy for what our clients go through and the setbacks they encounter. And I think doubly determined to be an even better version of SVB than we were for the 40 years that came before.
And during that weekend, was it all hands on deck, everyone at the office trying to fight all the fires?
It was all hands on deck, probably wouldn't even do it justice. It was a very hectic, chaotic 48, 72 hours of figuring it all out.
Yeah, and we named this panel Banking in the Post-SVB World. It's true that SVB is still here with a new owner, First Citizen Banks. And there are other banks, of course, that had to react also in real time when everything happened back in March. Mercury, for instance. What was your first reaction, and what did you implement to sort of make sure that you wouldn't become the sort of focus of attention?
Yeah. I think Mercury and SVB kind of mostly split the kind of startup banking world. So obviously when SVB was going through this, especially on that Thursday, the first thing we saw was just this massive surge of signups. I think more than 10x the normal signups we would get, maybe even 100x. So, from our perspective, we're also a startup, so we were like, all right, let's go, we've got more signups. Over the Thursday and especially Friday, we're like, all right, let's change from, this is like an opportunity to us to like a oh shit moment, in the sense that, I think SVB...
You could be the next one.
Well, there was two factors. I think SVB is a cornerstone and has been a cornerstone of the startup ecosystem, so, it's not good for anyone if there's a big failure and people's deposits are at stake and things like that. And then secondly, obviously, everyone was saying, hey, if this can happen to SVB, why is Mercury safe? Which is a very reasonable question. And we had like founders coming to us and saying like, oh, like tell us your partner bank's balance sheet. And I'm like, okay, I don't think you're really going to be able to judge this balance sheet. But it was very normal concerns. So from our perspective, we obviously a startup and we can react to these situations. So, what I was saying to our customers is, hey, we have 1 million in FDIC insurance, which is what we had then, and you can put the rest of your money in US government T-bills through our Mercury Treasury product. And then on the Saturday, I was like, I'm saying the same thing over and over to our customers. Why don't we kind of prioritize it? So we did two things. We increased our FDIC insurance from 1 million to 5 million over that week. And then we also launched a new product called Mercury Vault, which helped people see, whether their money was below the FDIC limit, and also help set up like the US government T-bill mutual fund and put all their money somewhere safe. So, instead of me saying, yes, your money's safe, Mercury's profitable, our partner banks are profitable, we could just say, hey, use this dashboard, you can see where your money is. And that's possible for us because we are a fintech and we don't host the deposits ourselves. We put deposits at our partner bank, and the way the FDIC insurance is extended is they then sweep the deposits over 20 banks, so you get 5 million.
And were you concerned about some of your partner banks, thinking maybe they are going to be contaminated with this banking crisis?
Well, so so the concern, why this is a concern and why it was a concern for SVB is normally a bank has a set of deposits. They then lend them out, right? Fractional deposits is kind of the cornerstone of banking. And so when someone comes to them and says, hey, I want all my deposits back, sure, they have a large percentage of them liquid, but in the case of SVB, it was like 50%. The run was like about 50% of deposits, which is very hard for any bank to be able to do. But the way we work is our partner banks are not hosting the deposits. They're sweeping across lots of banks, and each of those banks has a lot of liquidity. And these are big banks. All the kind of major banks participate in these kind of sweep networks, maybe a lot of them. So there's just like this kind of inbuilt like liquidity in the system that it's just a different model to what a normal kind of banking model is, and it's the model that a lot of kind of neobanks and fintechs do. So it gives us a lot of flexibility, and our partner banks at no point were like worried about liquidity. I mean, they weren't really lending any of this money out. So obviously it would be a concern to them and us if our customers were leaving. But overall, it was a big boon to us. Like we added in 2 billion
over the long run, basically.
No, even that week we added 2 billion in deposits, about 3,000 customers, and we were very on top of like making sure they had a great experience and we retained them. And even 90 days later, we retained more than 95% of them.
Interesting. Wendy, you started Piermont Bank in 2019, I believe. What was the experience like during that weekend for you, for Piermont in New York?
Sure. Well, having been in banking for 28 years, right? I was lucky enough to say that I've never went through a bank run situation. So even though, been around for a long time, that was still sort of caught everyone by surprise. But honestly, started that Thursday evening, actually. We didn't really have time to think because we started getting a ton of inbound requests. So Piermont, we're also the bank behind a lot of fintechs. We provide FBO services. We process billions of transactions for the fintech and their end users. So we started getting all the phone calls from existing our fintech customers.
So unlike Mercury, you're the back end, basically.
We're the bank, we're the partner bank, right? So, so the first wave came in with all the existing fintechs basically said, hey, we're moving our operating account, all the operating account money over, because they already have a bank account here. Yeah. So it was easier just say, hey, heads up, here's $30 million wire coming in, just make sure you guys process that. So we went through that first wave. Came Friday evening, obviously, the whole thing blew up. We started getting a ton of inbound calls from non-customers. So it went into a frenzy of just opening accounts. So the good thing was, so Piermont, when we built Piermont, is the first true digital-only bank that got a full charter FDIC insurance.
Which one? Which is the only one? The other one?
We were the first one, actually, to get that full FDIC insurance, full charter, commercial bank charter. So the way we built it was that we can open commercial accounts within a few hours versus a couple of days. So it made it easier for these new customers. So we started getting phone calls from private equity firms, like VC firms basically saying that I got these portfolio companies, can you open an account now? As in like now, immediately. So we didn't have time to think much of anything else other than just accommodating and getting accounts open. As we went through the weekends, so my chief banking officer is here as well today. So Rodrigo and I, we started talking about, okay, all right, we need to start thinking about what's gonna happen next week. We need to start thinking about when the dust settles, after the account opening, now what? Like, what is going to happen? What's the contingent? What else is going to happen? And because we're a regulated bank, we were also getting phone calls from regulators. Let me see your liquidity. Let me see your, we want to see your concentration. We want to see your uninsured deposit percentage.
The picture was very different before the weekend rather than after
the weekend. So
you had so much more liquidity.
So much more liquidity, but for the regulator banks, it was after the weekend. It was the weeks after when all the attention was shifted to, okay, you all have my FDIC insurance. Let me see what you got. What are you going to do? What's your uninsured deposit percentage, right? So I remember on March 16th, I forget who released it, a ranking order in terms of banks that has the highest percentage of uninsured deposits. Obviously, with, at that time, it didn't matter in terms of SVB, but it was on the top of the list all the way down to, they ranked 50 of them, including the largest banks on the list. So it was all hands on deck in terms of bringing down the percentage of uninsured deposits, right? That's for all banks. So this is something that, we probably don't even have time to dive into, is really about, okay, the dust somewhat settled, but what does that mean? What does it mean for the partnership between a bank like us and a Mercury, for example? We don't, not yet. But for their partner banks, right? What's that scrutiny? What's the direct impact, indirect impact, right? I'm sure you guys are feeling it as well. What's going to stick, right? So it was the weeks after and continues right now, even in terms of that partnership, especially as partner banks go through their cycle of annual safety and soundness exam, right? In terms of, hey, how well does the bank actually know the end users to prevent, in the event of a bank run, what do you have control, right? So we'll get into a little bit later. I think that it's important, at least I would love to share in terms of what are some of the things as a startup company, the questions that you really should be asking now from the banks, right? Because at the end of the day, as a regulated banking institution, from a product standpoint, most of us have the same products, right? It's about, okay, do they have the product? But more importantly, are they willing to offer you that product? Or is it that product only for larger companies, less startup, right? And the most important question, actually, without jumping ahead, is that can they recalibrate it to your needs? Like, can they prioritize you, the startup? Because that comes to the execution, the implementation part. And this is where I want to give credit where credit is due. That's why fintechs like Mercury do so much better from that user experience standpoint, is that being relevant, understanding the need for speed, right? You don't have time. You got investors telling you how to scale and scale fast, right? So can the bank actually work at your speed and then understand your pain points? That's really the difference. It's not the product. I mean, bank products are regulated. It's the same product, So anyway.
And let's talk about the big names as well, with Melissa from JP Chase. Of course, everyone knows this bank. Do you have a lot of tech customers and even young startups who want to bank with you?
We do. So just to give you a little bit of context about the innovation economy business at JP. So we have been banking tech companies for a very long time. And in fact, we have 220 years serving innovators, if you think about financing the railroads and Thomas Edison and the auto industry, which were innovators at the time. But really, I would point to sort of 2016, where we really built a very dedicated team. I totally agree with Wendy. in terms of making sure that we had that expertise to really understand startups
That
specifically.
you could be reactive, you could
Correct.
be top priority for these
Correct.
customers.
And I would say historically, kind of pre-2016, we had always benefited, quite frankly, from clients, tech companies, early stage companies that were maybe outgrowing their original banking partners. And so that's where we really wanted to focus to make sure we had built out the capabilities to serve a startup in sort of the very earliest stages. But during that, so we already had a very significant business sort of prior to the March timeframe, and then obviously on that weekend, which was clearly challenging, as Marc said, for everyone, for founders, for VC firms, for employees. And I would also, just as an aside, say, it is never good for any financial institution to see another bank in distress, right? Anything that causes individuals to question the soundness and stability of the financial system, not good for anyone. We would never wish that on anyone. And that's why we were very vocal with our teams to not make any outgoing proactive phone calls during that March, April, and longer time period, only sort of receive incoming calls. You could pick up the phone, you couldn't make an outbound call. But we did have a large influx of clients. I think, there's been a lot of sort of external, we haven't sort of said publicly, using our own data, but there's obviously a lot of external data that sort of points to a significant influx coming into JP Morgan. And so, that weekend, we were very focused, and to your point, Wendy, that March, April timeframe on serving the clients, new clients that had come our way. It was amazing to see sort of, as you kind of articulated, sort of our teams moving heaven and earth, and our ability to kind of garner resources around the firm to serve those new clients that were coming our way. And that was really our first priority. And we're very proud of that from a cultural perspective, that we, one, tend to be sort of the port in the storm oftentimes when there's some sort of exogenous shock in the system. Saw that during the global financial crisis, during COVID, during PPP, obviously during that March weekend. And it's very much, I think, in our DNA to serve clients. And I use that word serve very sort of specifically. And so that was, our first priority, to making sure that we could do that, quickly and flexibly and meeting their needs. And then secondly, we were focused, kind of post that immediate weekend on making sure that we were out spending time with all of those new clients. So hosted, a series of sort of events and tours around this various regions to welcome them to JP Morgan. And then the third thing I would say is, back to, we've been building this business specifically focused on the early stage since 2016. We spent a lot of time thinking about anything that we needed to do to meet the needs of those clients that we weren't already doing, right? So again, back to sort of making sure that we were listening to their specific needs. Felt like a lot of that we had sort of built already, but wanted to make sure that we appreciated any new needs that any of the new clients had, and where we could really accelerate our investment in serving this ecosystem. And that's why, we've hired 200 plus bankers and client-facing individuals, as well as, middle office, back office since the March timeframe.
And JP Morgan Chase, there's a big team behind the scenes. On that weekend, how many people were actually working to keep money flowing and welcome new clients?
Hundreds. I don't know that I have an exact count, but back to, we were pulling in resources, we were pulling in teams in India to help that weren't necessarily historically just dedicated on this client segment, but that is, again, sort of the benefit of a large firm, is being able to pull in resources from across the globe, quite frankly, to serve those clients.
And did you receive a call from upper management saying, how are tech clients reacting to that? Are they calling you? Are they worried?
There was definitely huge focus from Jamie on down, from the board. And, I would say back to, we've been building this business for quite some time. It's been a large strategic priority for us. And so I think, Jamie and the board were already sort of well educated on what we had been doing, but certainly were very intrigued with understanding how we were responding in that, sort of period of time.
Mm. And Marc, so all three here said that they welcome new clients. What's the situation like right now at SVB? Do you have as many clients as you had last year, for instance?
So year over year, I'm certain that the client count is probably a bit less. What muddies the waters a little bit is that we have clients that we were considering, if their balances post-March event dropped to 10% or less, we considered them to be exited, but also considered them candidates for reactivation. And so, unsurprisingly, what we've been doing ever since reopening with First Citizens is working with those clients to reassure them we're still here, we're open for business, come on back, the water's fine. And having, I think, a great degree of success with that so far.
And are there new clients coming to you and saying, okay, I have a
Yeah,
new
we're
company?
seeing new
and I
clients as
want-"
well.
Cool. And do you think keeping the SVB brand makes sense today and not switching over to First Citizens, for instance?
So we do, and I think probably the best evidence that First Citizens feels the same way is the brand campaign we launched last week, which is all about SVB. And so I think the assumption folks should have from that and so many other things we've seen in terms of First Citizens' support of SVB is that they are very, very serious and putting their money where their mouth is in terms of letting SVB be SVB in all of those right and important ways. And we'll figure out in the fullness of time how to reconcile that with the broader First Citizens brand.
And coming back to today now, as a fintech at Mercury, for instance, you have to pitch new companies saying, hey, you should bank with us. But I feel like many entrepreneurs are looking for stability right now. You haven't been around for that long. What's the pitch like?
Yeah, I mean, this SVB moment was an inflection point for us. We're still getting, I think, almost double the startups signing up every day than we did pre-SVB. And we already had a pretty reasonable scale. More than 50% of YC companies and every new batch use Mercury with a kind of exclusive banking sponsor for both Techstars and 500. So yeah, I think it's given us an opportunity to be the kind of default bank for startups. I would also say, I think this kind of comment that Wendy made that like banking is a commodity product, I think that's been the case because there's just not been any innovation, right? Like I've been doing startups for 16 years. No offense, Marc, but I really hated the banking experience I had. I think most people, like, I don't think we should do an audience survey, but most people would say, and you can look at the NPS scores, like no one likes their bank, right? Like it sucks. You have to call people to do basic things. They never make new kind of software products, right? Like a product to a bank is like, what's the loan that they can give you? It's not like a product-first company in the sense that, when people think PLG in the startup world, they're thinking like, amazing products like Figma, Slack, and Stripe. That's why I started Mercury. I was like, actually, this can be an amazing product. It can be something where, people sign up to Mercury and they're like, oh, it's such a joy to use, and I can like get my stuff done. And even basic things like search for a transaction without having to like poke your eyes out on a PDF, right? Like there's just so much room to improve banking. And that's how we see it. Like banking should be amazing, and we're launching things every week. We have a channel that says shipped, and we're like, we just did this thing and this thing. So it's just a very different view on like what is banking. And I think that's the future, right? That's like we only started 4.5 years ago, and we've gone from like 0 to having a significant share of like all startups.
Yeah, and it sounds like you're making it much easier for day-to-day banking when you are paying with a card or looking for transactions, as you said.
Yeah.
But what about credit lines, for instance? Do you think some of your clients are going to look at bigger banks like JP Morgan, for instance, if you want a big credit line?
Yeah, I mean, we have a venture debt product, so we launched that, I guess, 1.5 years ago, and we're investing in more lending products. Our primary focus is to be an amazing operational bank account. Sometimes we will have the right loans for you. We also have a product called Capital Guide, where we will help you find like other lending partners. The reality is like lending is not banking. I mean, it is banking, but there's banking that's like running your business banking, and then there's lending, which is another part of like a service that some people need. Most startups don't really qualify for lending, so it's something that comes in later on. But by that stage, often people have multiple bank accounts. So we see very high retention, even as companies kind of scale with us, and we have companies with more than $200 million, many using us.
Nice. And maybe you mentioned multiple bank accounts. That's my next question. Do you have some feedback from clients saying, okay, I'm done with having a single bank partners. I want to work with multiple banks. Do you get these calls? Who wants to take this one?
You want to start?
Oh, I was just going to say that, yeah, I think especially that was the case during the immediate aftermath of in March, because that's when everybody felt like, okay, I got to diversify the so-called risk, right? But I don't think at the time people can really articulate what that risk really is. So I think there's that perception versus also from a practicality standpoint. Because for regulated banking institutions to properly manage the risk and also to be able to give that holistic service is that they need to be able to see all your banking activities. That's part of that's risk management 101. I think from a practical standpoint, is the bank gonna allow you to spread all your cash at, let's say, 5, 6 other banks? One is, does that even make sense, frankly, for you? The customer certainly doesn't make sense for the bank. So that, I think, is one of those things that we'll see how it's going to pan out. And at the end of the day, the regulators also have a say in this, so to speak, right, in terms of how the banks are managing the risk. But overall, I think from just a product standpoint, because in our ecosystem, we always talk about what's table stakes. So table stakes, we're talking about often functionalities of these products, right? But what we tend to overlook is that what's the most important table stakes is actually understanding the fact that change and the speed of scale of a startup, that's actually a table stakes in understanding how you deliver banking products, actually.
Because it changes over time?
It changes so often, and traditional banking are not dealing with customers that changes this often and this fast. So often it's there's a mismatch, or at least a gap, in terms of what it is that the startup needs versus what the bank is willing to offer, so to speak. Because at the end of the day, are we kidding ourselves? SVB, JP Morgan doesn't have all the products? Of course they do, right? So it's about, okay, how quickly can you react and respond and do it in the way that's relevant to them, right? So this is why we started seeing all these neobanks that took place in the last few years. The issue there, I shouldn't say the issue, the challenge there, especially in the post-March event, is really about, sorry, Marc, no, seriously, sorry, is that it's the dependability, right? The same point that you need to be relevant, you need to be fast in terms of delivery. Should you be working with a provider where whatever it is that you need, they need another third party to agree to it, to dance? Right? Because if they don't have a good dance partner...
Too many layers.
Yeah, too many layers. So how direct, how dependable, right, your banking partner is. That's also really critical I think, in the world going forward. So I don't think any one of us have a good answer. And frankly, you got a great mix of providers here. You got JP Morgan. I started out my career with JP Morgan. We were just chatting about chemical bank, Manny-Hanny days, right? You got Mercury, who has a banking partner. You have Piermont, who is a new bank, but we're fully chartered insured. We're a regulated bank. And then you have SVB now join a larger, part of a bigger family. So what matters to you, the startup? What's relevant to you changes. So you got to make that decision. I've always said we're not everyone's cup of tea. You're not every bank's cup of tea. So you got to just figure it out who's willing to offer what and how quickly you need it. Right? So to sit here and somehow to pitch that, oh, wait, this is the answer or this is the answer, that's dumb. Come on. Just like you guys are different too, right?
Sounds like... Yeah.
I mean, I think Mercury is the answer. If you want to diversify...
Try to be the bigger person.
I know, but if you're trying to diversify across banks, you can get the $5 million in FDIC insurance across 20 banks. You can get Mercury Treasury, which gives you kind of direct US government T-bill mutual fund access. So yeah, I think at a certain scale, it will make sense to have a second bank account, operationally or for whatever reason. But I mean, that's a pretty big scale, right? Like 5 million FDIC, that's more than enough to cover a pretty large startup's operational activities. And then you can get kind of US government T-bills for the kind of excess cash management. Yeah, I don't know. I mean, I'm sure JP.
I'd love to add to say this. That you've got
that's perfectly leads to that willingness issue, because this whole reciprocal deposit, being able to insure, frankly, up to 100 million, so to speak, you got IntraFi, you got RNT, you got proprietary, everybody has it. This is what I meant by banking products. It's a commodity,
I mean,
unfortunately.
that's not true.
But-
I mean,
but-
try
hold
signing up to these guys and trying to get that product. Like,
Well,
it will
see,
be an experience for
But
you.
this is what I mean by willingness, is that are they willing to offer it? The product exists. The
I think-
functionality
But
exists.
more
People
seriously-
should get the best product. They shouldn't have to like jump through hoops to get it, right?
Yeah,
Like,
yeah.
I would take a step back and think a little bit about, so we get this question all the time,
Yeah.
right? And I would certainly argue, as I think many people would agree, that for a startup specifically, right, that it is often going to be inefficient to try to manage multiple banking partners, particularly for a team that is obviously lean and mean, and generally speaking, there is no finance staff, right? There's no staff per se. So I do think that that is not necessarily the most efficient option, and I do think as one thinks about managing, counterparty risk, some of the off-balance sheet liquidity options that are available through sweeps and that sort of thing are a good option for a startup. Certainly, as the company grows and scales, it would make more sense to be thinking about multiple providers, and I would say that's usually when your financing needs also have come to grow and scale. But I would say the most important point, and I agree with Wendy here, in choosing that banking partner, particularly when you're choosing one banking partner, is safety and stability, what I would sort of phrase the fortress balance sheet concept, as well as, and this is, I think, the point you were making, Wendy, thinking about not just what you need today, right, but thinking about who can best help you grow and scale and achieve your objectives, not just from a pure banking account perspective, but all of the other things, whether that be industry expertise, subsector expertise, access to strategics, partners within your space, the networking opportunities that a larger institution can give you access to, I think is critically important. And I would also just say, again, is thinking about, so not taking that, that view today, but who can support all of those capabilities that you need over time. And again, having that dedicated team that can do that. I agree with you. If you go to a traditional commercial bank, they're not going to be able to understand the challenges that a startup and a high growth company faces. You need people who traffic in that all day long. And the only other thing I would say for this audience in particular, I think because there's a lot of fintechs in the room, is I do think it's critically important if payments is kind of part of your embedded solution, that you are building your architecture to accommodate more than one provider. And that's from a business resiliency standpoint. That is just good advice in terms of business resiliency, as well as payments optimization to make sure that you're able to offer to your clients all of the alternative payment sources that are out there and continue to be developed. So that's how we think about it.
And a quick comment that I think will be additive to this, because we just did a survey. And so backing up, we just released our most recent State of the Markets report, one of our longest running insights report. And in connection with that, I recommend you all read it, find it on our website. But what you would see in there is a survey we did of 80 VCs asking this question. What's important to you about the events post-March? And unsurprisingly, we heard treasury management matters a lot. That, I think, was new news to many folks who didn't spend a whole lot of time on that. And the recommendation that we heard that I think reflects the comments up here was for revenue up to $100 million, the median answer was 2 banks. And I think that was rooted in the complexity of having more than that, the reality of having products out there like Insured Cash Sweep, which literally are. I think we all have them and are making that available. And so if that context helps, that's not my advice, it's the venture capitalist advice of what they're saying in connection with us.
But it's clear that there's a cultural difference here between the four of you. And Immad, you mentioned that half of YC companies create a Mercury account in the current batch. Who is your biggest client right now?
Like literally the biggest?
Yeah, with most money and most revenue.
I don't think we'll like say their name, but it's.
Is it a public company?
We have a couple of public companies. I think the biggest one is a private company. To connect to what someone was saying earlier, startups can grow really fast, right? So we have a lot of companies join us at seed stage and then Series A and B, and suddenly they do a $100 million round, and they continue to use Mercury, and that's we've been doing this for 4 years, so we have several companies that are at that like in a later Series D plus stage. And
conversely, maybe at JP Morgan Chase, for instance, do you think you're going to become as feature-rich as Mercury before Mercury can become as mature as JP Morgan?
Well, I'm not going to predict what Immad could do over here, but I think that we continue to serve, right, sort of the very earliest stages of this ecosystem, and I think the important part back to thinking about a banking partner that can grow and scale with you is as you get bigger, as you think about an IPO, as you think about potential sale of the company, again, much later, right? That we have the resources and the teams that can help you think through that from a capital structure perspective, from an investment banking perspective, from a world-class private bank. So I think the ability to sort of serve all those needs, starting with startups, serving those needs specifically with tailored solutions, but then having the ability, as I like to say, you can't outgrow JP Morgan. We can serve you from sort of startup to IPO and beyond.
When we launched Mercury, there was only 9 people, and I was definitely worried that, like, oh, someone could build this, right? 9 people built it, but now we have 530 people, and no one's really built much in 4.5 years, so I'm pretty sure no one will catch us.
All right, that's all the time that we have, but it was great to get some laugh on a panel about banking. Thank you so much for paying attention, and have a good Disrupt, everyone.
Thank you.